right, everybody, we're going to get started here. Just in case you haven't gotten coffee or water, don't leave now, but after I'm done, you can go next door, and there's coffee and water in there for everyone that needs it, okay? So for those of you I don't know, my name is Nick Framerini. I am the Director of Advocacy for BAC. I'm also a local mortgage broker as well. Brenda would tell you that I'm number 2 in the DC Metro behind him since he loves competition so much. Today, the panel I'm doing is about legislation, regulation, and lending, but we're taking it from the insights of the leaders here from the wholesale industry. So I've got KP from PRMG, John Wise, and then from NewFi, and then I also have Phil Shoemaker up here from the Loan Store. So appreciate you guys taking some time out of your busy schedules. We all know they're super busy. So thank you for coming out and supporting what we do here. So to kick it off, can I have a general question for all of you? I've luckily gotten to know most of you here over the past couple of weeks, so taking some time to chat with me beforehand, and it's been good to get to know you guys. A fun group of guys up here. So I'll start off with you, KP. What shift from a regulatory and legislative have you seen in the last 12 to 18 months that's kind of had the biggest impact on the wholesale industry?
I'll say. Dodd-Frank is still like the king of all the regulation that has impacted wholesale. And there was a lot of talk about repealing LO comp a long time ago. And don't tell us what we can make for a living. Don't cap my compensation. But it's actually put a cap, that 3% cap on LO comp forces everyone to take 275 or less in case there's some quarter wiggle room or whatever. It has made pricing better for the wholesale channel, and so I don't think if that cap was lifted, people would be like, all right, well, let's try and make more, let's try and make more margin, and then that price advantage of that channel gets eroded. So I still think that's probably the king, but something that Phil was really pushing. That I still think is probably the biggest one is that core, 50 basis points? The 15-ish, yeah. So for whatever reason, there's an extra little bump in pricing to make pricing worse for TPO files, for wholesale files, and in the secondary market. I don't know if I'd call it legislation, but it is certainly a negative for pricing in the wholesale channel, and I think Phil was the first one to bring that to light and talk about it. We were talking about when we were both part of the MBA, and I think that needs to go away. I mean, the quality of the business in wholesale is fantastic. It is more refi heavy than distributed retail, and so a little bit less purchase business, so there are higher prepay speeds, and I guess that's the logic behind that. But the performance is great, and I think that would be one we can continue to work on and try and chip away at. Although it's really hard to talk to anybody at the GSEs. Mark Calabria is at CFPB oversight of the GSEs, then he will shift over to the Office of Management Budget to try and work out getting Fannie and Freddie out of conservatorship. And that was our spirited, lively discussion we had. And I'll just stop there and not hog the mic. Go ahead.
Yeah, John.
Yeah, KP has the tendency to talk in 8 to 9 minute segments.
15.
For those 15. Of you who are familiar with KP's LinkedIn
profile. When LinkedIn went from 10 to 15, it just my engagement went off.
So I appreciate that. Up here as a representative of the non-QM industry, we think about these things a little bit differently. I do agree with KP that Dodd-Frank is really the major legislation that we think about establishing QM versus non-QM. So you think about you asked about the last 12 to 18 months, and the way we kind of think about it is the last 12 to 18 months, the wind has been a non-QM back. We are just been growing like crazy. So we're really head down and focused on growing an industry and a company. And so we really haven't had any legislative issues that have gotten in our way. But when we think a big picture about this industry, you think of what you really want as an originator is good, efficient access to capital. That is the thing that you want the most of, and the more you can get that, the better your opportunity is to compete every day. So, I think what we represent up here is the same as what you guys are out there doing every day. It's getting up and competing for that borrower, for that next transaction. And the more efficient we can get you to the actual capital, the better chance you have to compete. And I think that's how really we think about the non-QM space. Certainly it's evolved over the last 4 or 5 years. But today, I represent a company that's really a balance sheet lender, so direct access to that capital. And the second piece of it that I think is important, and I don't really think this is a legislative change, but the other piece that's really important, the thing that has killed this industry over time is access to a liquid market, and the more liquid we can make that market, the better. And that's really what I think that the private capital space represents today. And so I don't really think there's much legislative action. Now, the one thing that we do worry about is when you think about the last 12 to 18 months, really the last 100 days, it has created a ton of volatility, and that's bad for the mortgage business. So we hope we kind of get through this in a way where we get rid of that volatility. It's bad for you. It's bad for mortgage companies. It's so hard for mortgage companies to make money that when you have that volatility, it's tough, but it's also impacting your borrowers. You have these, anytime there's uncertainty, that borrower is going to kind of step back a little bit, maybe not buy the house. And so anything that we can do to try and stabilize the market, I think is going to be a healthy thing.
Great. Phil?
Yeah, so I want to start by saying y'all are awesome for being here. I think that's pretty cool, and I would like y'all to give yourself a hand. I'm going to try to clap. And thanks, Nick and Brendan and Rachel and the rest of the back team. You guys are doing good work. I'm actually really excited to get more engaged, and I'm going to get more engaged in the NBA again. I'll bury the hatchet. So I think, there hasn't really been a lot of regulatory change, right, in the last, what was the question, 12 18 months, right? But if you think about what's happening with specifically the last 3 months and the gutting of all our regulatory entities, right? The CFPB, Fannie, Freddie, not really regulatory entity, but still matters, HUD, VA. I think that's going to have a profound effect on things from a regulation standpoint. And some of it will be good, some of it will be bad, right? So you got most recently, the CFPB has kind of come out and they're rolling back some enforcements that they've done. That, the biggest issue that I've had as a lender with this regulatory environment is this whole regulation through enforcement. It's a really dangerous way to regulate an industry because it creates fear, and it definitely causes lenders to contract. And from a liquidity standpoint, it's not good. And so I think there's going to be things that are good about it, but at the same time, it's like we need regulators. And those regulators need people. And so I don't know what I don't know how we feel about that. I think, again, some of it's going to be good, some of it's going to be bad. I do think it's going to be really freaking fun to watch, man. I think the time that we're actually operating in right now, how many people lived through the financial crisis? I'm just curious. Oh my God, this is actually a pretty seasoned group. Because normally I ask that question, there's not a lot of people. Right? Aren't you feeling old? I know you're old, but I'm
really
feeling old.
That's what I get for telling them how old I was when I got up here.
No, it's like, so I remember going through what Kevin was talking about, the Dodd-Frank and all the regulatory change that came about as a result of the financial crisis, and that was a miserable time, but shit, it was a lot of fun. And I think we're about to kind of go through something similar. And so, again, don't know what it means, but buckle up, get ready for the ride.
I think when I talked to all of you, you all had mentioned, a lot about the CFPB, kind of being a shell of itself and just regulation in general, and that a lot of it would be falling back onto the states is kind of all a growing point amongst all three of you. Open question to any of you, is there anything that you think would be great for the folks that are out here to be present out for their states with this change in the regulation and probably falling more on the state side of things?
Well, I'll give you a list of some states that are tough and some of the things that they're doing or plan on doing. Massachusetts is tough. California's tough. Washington State has their quirks. Surprisingly, Kentucky, of course, North Carolina, because they're a banking hub. So you're going to see some of these states step in. Illinois is very tough. I think states implementing their own Community Reinvestment Act, CRA legislation will impact our business, and it'll probably hurt us as lenders more than anyone here. Just hurt us as far as like the type of products that we have to do, which is counter to what HUD just did when they got rid of non-permanent resident aliens. You know, which is like the one thing I think we should be talking about. I mean, 5% of our FHA book, which is about 2.5% of our loans last year, were non-permanent resident aliens. If someone's here on an H-1B visa, they're on the path to citizenship. They live and work here, and they need to buy a house. And I thought that was kind of stupid for them to pull that back. But they are, I mean, you know, all the word I got yesterday is they are not pulling that back. So I think that's a problem. And you know, you guys heard about these false claims acts. You know, people, you know, we take risk. Obviously, in non-QM, we take risk in government loans. And if you did shitty loans and you threw them in your portfolio, you could get sued for tens of millions of dollars, you know, by these blood-sucking attorneys that say, well, you defrauded the government, you know, the FHA insurance fund, so we're going to hit you with the False Claims Act lawsuit. We were like 28 lenders in a row got literally, I mean, there are lenders like Academy that went out of business and had to sell the guild on a $38.5 million fine. 28 lenders in a row got clipped. We were really pushing for Rocket when they had their lawsuit to take it all the way to court and like end this bullshit for once and one for all. But it's a money grab, and you sit there and do the math and go, it's not worth fighting it. We'll just settle. We were number 29. We got our card pulled, and we beat it. We had good policies and procedures. Office of Inspector General said, hey, there's no there. This PRMG is good. The way they, you know, self-report if there's a problem inside their FHA book, and we have written policies and procedures. And I think it's a lesson for everyone here as you grow your businesses, you know, to have written policies and procedures of how you operate, when you give price exceptions, when you go borrower paid, why you go borrower paid, what is the waterfall. Because you will have, maybe not in this 4 years, but you'll have a CFPB fair lending exam, and they'll come knocking on your door when you least expect it, or the state will if the CFPB won't, to your point about the question. So when do you guys give price exceptions and go borrower paid? You know, is it only for white borrowers who are shopping you? I mean, that's the regression analysis that the states are going to do on your data. Have the data. Document every time you do a price exception. Put something in writing in there. I mean, take this back and tell your teams, because you could get sued. You know, a few $100,000 would be damaging for anyone in this room. And I'll just say one more thing. There's a lot of non-permanent resident aliens that are already on an FHA loan. And if you streamline them right now, you know, it's, you know, Freedom does it in 10 minutes. You know, that's how quick they underwrite. If you streamline a non-permanent resident alien, you are setting yourself up for another False Claims Act lawsuit. So we put some controls in place last week to, you know, flag those borrowers when they come through our system and Encompass and make sure we don't do it. So those are probably the high points and the things that I think are to be leery of from the states coming.
Yeah, I mean, I would say two things. One of the things that we find all the time, especially with the CFPB, not quite going to zero, but let's call it going to zero, that there will be the increase in states' powers. Is you're going to see this more and more. They'll get more aggressive in their audits. They'll get more. Some states we think will do that. So I think that what we would find good for the industry, certainly good for the non-QM space, is some more heterogeneous or homogenous regulations. I mean, trying to manage, if you just take the prepayment penalty issue, like every state's got a different prepay penalty and the different laws and different rules. And so the more consistent we can get in those laws, the easier it is for us to do business. And again, it goes back to this point of efficient access to capital. Anytime you layer in regulation, it becomes more difficult. We have to layer in bodies and time and process and people to manage that, and that increases our costs, which then gets passed on to your borrowers. And so the more consistent we can have the state's laws, the better industry we're going to be. And then the second thing, I think is really important to say is as we move into this deregulatory environment, it's on us, it's on you to originate good credit. It's the one piece where when I think about the non-QM space, we've done a really good job of that, and without a lot of regulation. we've kind of flown under the radar a bit, and it's for a lot of different reasons, but it's because we're originating good credit. So when you're out there talking to people in your state, all these loan officers that work in the territories that you manage or the companies that you manage, it's about making good loans. If we continue to do that as an industry, we're going to thrive, regardless of what regulatory environment we're in, and that's really the key. It's one of the reasons why the non-QM business has grown so much, is because these loans are, for the most part, performing. We are seeing some delinquency rise in some of the, call them it's not really non-ATR, but no documentation loans. We're starting to see some of those delinquencies rise, and things like the CDFI loan, no
Shocking.
show DSCR. Yeah, surprise, surprise. I mean, we kind of know this when you make the loan. You know this, but you have to be really careful as an originator today in making those loans, because at some point there's a chance that those things could come back to you, and that's what we're mostly concerned about.
Those loans put Phil and I out on the street unemployed in August of 2007.
Yeah, all three of us. Yeah.
Yes, they did. Making good loans is a good rule. So, yeah, kind of off the first point. So it's the regulatory environment is always a pendulum, right? So you're either, and it's always politically driven. So you'll see the federal side will be hyper aggressive, and then the states kind of back off, and then the environment we're in right now, federal side is going to be more pro-business, and what that's going to mean, and why all of us needs to really care about this, is you're going to see the states step in big time. Now, some of you live in red states, less of a concern, but it doesn't matter in that you'll have these kind of state coalitions that'll form, right? So you'll like New York is always a big one. By the way, I won't get licensed in New York. That's how passionate.
We won't either.
I fucking hate New York.
I'd like to.
I love the city
here from
and the
New York.
people.
I love this. I love the state. I just don't like. There you go. I just don't. And I do business purpose loans there all day. But I won't get licensed there. And the reason for that is because what they'll do is the states will start to band together, and they'll latch around the regulators in that state, even if it's a red state, will latch around one of the more aggressive blue states, New York or California. And this really matters in wholesale, because if you think about really who your regulator is, look, if some of the big brokers will get visited by the CFPB, right? But it's very rare that you're going to see the CFPB. They just don't have the resources to go into all these thousands.
Well, it's already happened. The 1099 thing is happening in certain states.
I know.
In Arizona.
That's right. That's exactly right. So what you'll see is the states are going to lean in, and I think they're going to lean in heavy. Like, you're going to see audits kind of start to ramp up and whatnot. But I think to the point you were making, at the end of the day, like, the environment will change, right? So it'll be pro-business, not pro-business. And so at the end of the day, if you're just doing the right thing, you'll be fine, right? So make good loans.
Yeah, and I think it all comes back to, like, obviously we're here these days for the fly-in to go to the Hill for a federal perspective, but just speaks to why being involved in your state on the legislative side is so important, especially these days, if it's going to be a lot more state involvement in the auditing and the regulatory enforcement. Kicking back to you, Phil, kind of KP mentioned on it earlier about the 15 basis point surcharge. I'm a little bit familiar with it, but there's obviously some in the room who may not be. Would you mind explaining that quickly? And then do you think we have a better chance of fixing that now with the current administration?
Yeah, so this is an interesting one. So after the financial crisis, they put in something called the capital rule. Do you guys know what that is? I'm just curious. If no hands, that's good. There you go. KP knows. So basically what that was it's a framework, a capital framework, where it's like a 300-page document. It's really fun to read if you're trying to sleep. And it lays out all these different risk aspects of a loan, where based on a loan being perceived to be more risky or less risky, the agencies, Fannie and Freddie, are required to reserve higher or lower amounts of capital, right? And reserving capital creates expense, right? Capital is expensive. And so in the case of wholesale, if you look at that framework, it's all based on pre-crisis data, right? And the main premise is that it's somehow riskier to originate a wholesale loan, which, by the way, it was pre-crisis. If you looked at the default rate pre-crisis, it was upwards of double, right, what you would see coming through retail. Now that changed, and the reason why that changed is because, there was as you guys, because there's a lot of hands, probably remember, there was a heavy emphasis from a regulatory standpoint on wholesale. I mean, the main goal after the crisis was to kind of put wholesale out of business. I mean, they wanted wholesale gone. They capped comp. They made all these really, the disclosure, as you know, is more. There's more requirement.
HUD got rid of the mini Eagle.
Exactly. Yeah, exactly. And so, but what that ultimately did is it forced people to adapt and actually run a better business model, which oddly enough, to your point, is why wholesale has an advantage. We'll get into that, I think, later. And so going back to the capital rule, though, they haven't updated that data. And so even, to this day, there still is this perception that wholesale loans, even though we've shown time and time again that wholesale loans actually perform better than retail. And the reason for that is because there's more checks. There's more checks and balances, right? You guys have your checks, and then on the lender side, we're doing our checks. There's just more checks. And so it's out of date. It doesn't need to go away. There should be a capital rule. That was one of the issues that we had with the industry pre-crisis, is that there was a mismatch in terms of the perceived risk of loans and the capital that was being reserved against those loans. It just needs to be updated, and I actually do think that we do have a good chance now with the current environment. I mean, it's fine. So it really didn't even start to get enforced until 2021. Is that right? I mean, it was there, but Fannie and Freddie didn't enforce it because FHFA wasn't really requiring them to. And so I think that what we're probably going to see over the coming months is there will immediately be a relaxing of the enforcement of that rule as the execs of Fannie and Freddie change. And then at some point they need to go back and do another analysis, which will show that wholesale, and you guys should be proud of that, is originating better loans. Let's keep it that way.
Great. And bringing up FHFA, KP, you and Phil recently went on back Facebook Live debating about whether or not it was a good thing for Fannie or Freddie to come out of conservatorship. To be honest, I got in the business 2015, so I've never done a loan without TRID even being around. So I kind of know the devil I know of GSEs. There's obviously a lot of the folks in the audience who have been in the business before they were GSEs. So I guess if you wouldn't mind just explaining a little bit more about what it fully means to come out of conservatorship, and explain to everyone the system best you can.
Show of hands for anyone that saw our Facebook. Oh man, we gotta pump those numbers up.
One.
Those are rookie numbers.
One.
Those are rookie numbers.
Let's do it again, Ken.
Yeah. Wow. Fannie and Freddie being privatized like they were before September of 2008, which I had a little small lender in between First Magnus and PRMG, and man, I remember personally filling out the package and getting us approved with Fannie Mae, and then two months later they were conservatorship, and it was a race to raise money. It's all you guys know. We love serving our veterans. We love serving first-time homebuyers. We love that part of the business. The secondary market, we just buy and sell money. And the secondary market is cold, heartless, and unforgiving. It is about money. And does this mortgage-backed security that trades just about as high a quality as a treasury, does it perform? And so Fannie and Freddie Mark Calabria is a libertarian, and he is on a mission. He wants LFG, less federal government, and he is driving this bus. And one of the guys who was at this MBA event I was at this week went and met with him. And right now, and all this crazy stuff, he's friends with them, say met. He's like, yeah, Elon Musk's office is over here, and McKiernan, his is over here, all this stuff. I mean, it's crazy, but he's like, it kind of makes our discussion debate moot. They are going to try and make Fannie and Freddie private without going through Congress. So they're just going to spin it out. And they think it's a 2 to 3 year proposition. That's what Mark Calabria told this gentleman the other day. Now, I don't know who's going to own it. I think the reason the 2 and 3 year time horizon's on there is because it'll get the U.S. Sovereign Wealth Fund up and running, which, by the way, I love. It's about time our country actually makes money on our money. When we're like the dumbest country when it comes to money. We just get ripped off everywhere. We don't invest money, and we have a 222% debt-to-income ratio. I mean, seriously. But China's 300%. So we got
that's a
could
bad
be
loan.
worse. So when Fannie and Freddie go private, and I think there's a lot of headlines like they fired the CEO of Freddie, that she was a DEI hire or Biden implant or whatever. I actually think my first thought was that they're going to kill Freddie and just have one. That was my first thought. I have no knowledge of that, but it's just my intuition, my street hustle, street knowledge. But if Fannie's private and someone owns it, they could go, yeah, Phil, we don't agree with your data. We're going to do a 50 basis point hit on wholesale loans. What are we going to do? They're private. They do what they want. Yeah, we're not going to buy form free. We're going to only go with Plaid and Finicity. These guys over here, you're on our blacklist. You did a bad loan one time as a broker shop. You can never do a conforming loan ever again. That's the scary part of a private Fannie. They move slow, and Phil brings up one of the most unique points I've heard, which I actually really like, is that a private Fannie would maybe be technologically faster and more innovative, but they'll do what they want to do, and that's it. And so I always say, careful what you wish for.
Phil, you want to?
I'm curious to hear his
I was
thoughts.
going to say on John's side, obviously, non-QM wise, like how do you have your perspective on this?
Yeah. So if we work with the assumption that they are going to be privatized, and I think that's the current assumption, then the question becomes, what direction are they going to go? If they decide to continue to scale back, like they did with the H-1B visas, and reduce their credit box more towards their charters, then there's a chance that private capital could step into that space. That's what we're here for. That's why we exist. So when you think about non-QM, most people think about non-QM as a bank statement loan, as a DSCR loan, it's I-10. That's not really it's why we exist today. We fill that gap in between the agencies and hard money. That's what we're here for. But we think about it a lot differently. We think about it potentially filling a larger gap if the agencies decide to scale back their business. So that's definitely one way we think about it. There is a chance that we go the other direction and they get privatized and they start doing bank statement loans, they start doing DSCR. And for us, it's totally fine because this is what we love to do. We love to compete. Like that's what we've been trying to grow this space for the last 10 years, and we do it by doing the same thing you guys do, like what I said. We get up and hustle, and we help you close more loans and get bigger, and so that's what we're about. And so we'd be totally okay with that because we're okay competing, and we're owned by one of the largest private capital firms in the world, like third largest private equity firms. They've got plenty of capital to support this and continue to grow as a bigger part of that of the space. And like I said, we fly under the radar, and that's good news because we're performing. At some point, if we start taking a little bit more of the business, we'll probably get some people's attention, and we're okay with that because we're making good loans and doing it in the right way.
And let's say they did open up the sandbox, so to speak. Let's say they did allow bank statement loans and things like that if they went privatized. Now would that, obviously non-QM loans tend to have a higher interest rate. Would that in turn lead to us seeing more of a lower rate with those for our clients?
Well, so what we've seen over time, if you think about the non-QM space like 10 years ago, the spread between agency and non-QM was like 300 basis points.
Yeah, way more.
Today it's 50. Sometimes we actually have better pricing on some of our non-owner products than some agency people do. So the spreads come way down, and that's because real money has come into the space. And when you get real money into the space, like insurance companies and people like that, you're going to drive that spread way down. When you combine that with loans that perform, again, make good loans, we're all in good shape here. It's going to continue to drive that spread lower. One of the things that's come up in the last 30, 60 days is they weren't going to privatize Fannie and Freddie until they were sure that wasn't going to increase the cost to the borrower. And I don't know how you do that. I think that's a really tricky thing to do. If you lose the government subsidy, your pricing is gonna probably go up, and if it goes up, ours comes down. We look very similar.
You guys are Fannie Freddie approved?
Yeah.
Yeah. So Good, because what I'm going to say is, Phil and I are on this executive, roundtable that CoreLogic, now Cotality, puts together, and we meet with Fannie and Freddie. I've been meeting with the head of Fannie and Freddie's credit risk personally, one-on-one meetings 2 to 3 times a year the last 3 years. Also with Jake, their head of collateral. And I tell them, I was like, you guys need to do bank statement loans. You need to do bank statement loans. You're getting 12 to 24 months data, and why wouldn't you want to do it? They already do cash flow underwriting for AMI borrowers, low to moderate income borrowers.
I'm trying to retire in 5 years, so it's like sometime after the next 5 years would be good. KP?
But you'd be able to do so much more of it, right? So there'd be a lot of it, and we do about $80 billion a month in non-QM. $80 million a month in non-QM. I guess Scotsman says we're the 7th ranked non-QM lender, but I would love to see Fannie and Freddie do bank statement loans.
Yeah. So
better rate for borrowers.
No, I agree with that. So I think a couple things. So one, even when Fannie and Freddie, it is a win. It will happen. They'll come out of conservatorship. They will be privatized. It's just a function of time. Even when that happens, they're always going to be heavily regulated by the government. And the reason for that is it goes all the way back to their founding charter. I mean, they're pseudo-government agencies, and that will not change. And so I think that the way I look at this, it's kind of like, I'm going to get ahead of myself because I know this is one of the questions, but it's kind of why I'm so passionate about wholesale, is I believe that anytime there is a free and open market, everyone wins, right? And I'll use you guys as an example. I spent years beating my head against a retail brick wall, managing that. Not that I don't like retail. There's good originators there too. I'm not saying that. I'm saying that the way it's plumbed, the fact that there's a complete, because of LO comp rules and Dodd-Frank, they introduced a complete misalignment between originators and how the lender needs to make money, right? And so originators, can go out in retail and do whatever they want without any regard to actually running a profitable business. Wholesale, right? The reason why it's so awesome is, like, as a lender, I can focus on being the best lender while you guys get to focus on being the best originator. I don't have to worry about policing you. And if someone in this room wants to go hire 20 LOAs and can make money, with 20 LOAs doing 1 loan a month, God bless you, right? The market's going to take care of that. And so it's kind of the same argument with Fannie and Freddie, right? It's like, I think that the purpose of government is to create a common framework for us all to exist, right? For people to have differing philosophies, points of views, right? That's the purpose of government. It's not their own business, right? There's not one instance, I'd be curious, anyone in here, can you give me one instance where the government ran business and it worked out well? It's just...
No one has ever said that. I'm like, why are we complaining about firing all these people? No one has ever said that.
And but to your point, so I think...
It's our money, by the way.
I think I'll make 2 points on this that you guys already kind of touched. It's like when they come out of conservatorship, there still will be a capital rule which keeps them grounded. There's still going to be heavy oversight from the government. If things go too far, which oftentimes they do, the government has no choice but to step. The second largest bond market in the world, housing is the biggest part of GDP. If they falter, regardless of being private, non-private, whatever, government's going to step in and do what they do with quantitative easing. They're going to do that, right? That isn't in question. That will happen. But being private does put them back in a position where you have 2 things that will happen. And John touched on one. Private capital will come back in the market. That's a big part. And yes, there might be a short-term spike in costs. There's going to be some, I'll say, turmoil, right, that comes about as a result of this. But when you get private capital in the market, now you have optionality, you have people competing, which then leads to innovation, right? And I'll be honest, I'm kind of tired of this fucking industry not innovating. I've been in this industry now for 28 years, right? And I used the word fuck. Is that all right? Can I do that, Brendan? You're good with that? Okay.
We're Facebook Live. You're good. There's like 7 viewers.
I've been in this industry for a long ass time. Now we're like I'm literally the old guy in the industry, which is really sad. It's been kind of fun to watch the young people like Katie and Anthony come up. I will say that's been a lot of fun. But now I'm the old guy. And what I can say is I came in through tech. That was my original role. I'm an engineer. And I used to, my goal was to like create a black box where you have data come in, borrower, and then out on the other end, comes a loan. That was the first Magnus we were trying to do there. And it's just, nothing's ever changed. And costs just keep going up. And so that screams that there is a structural problem with our industry. And I think it has everything to do with the fact that you do not have private capital, free market, and as a result, innovation.
I'll just add that one of the things we were talking about was the explicit guarantee, and the government would back it. And so my point about the sovereign wealth fund is that if that fund invests in the preferred shares of Fannie and Freddie, which are private, that is the explicit guarantee. So our U.S. government, our sovereign wealth fund, being a shareholder of a private Fannie and Freddie, that would backstop it. And that's a good thing, because we all saw in COVID, a couple things happen. Nobody but the U.S. government has enough money to backstop this housing industry, period, end of story. And we'll just print money and make it work. And that's what we do. And private capital just can't do it. There will be another pandemic. There'll be another trade war, maybe this week. There'll be another, geopolitical event somewhere, and something will happen. And people, what happens if, I used to live in Fort Lauderdale. You see all these videos from CoreLogic. By 2030, there's there's no shoreline. And so what happens when, another, Champlain Towers gets knocked down? It's flooding in Miami last weekend, it's 2 feet of water downtown. What happens when there's, 27 less condo towers? Insurance rates will go up even more. Who's going to backstop the high risk that is a loan, not just on a condo, but in a coastal city? And so our debate kind of about the explicit guarantee kind of became moot, because they're going to take Fannie and Freddie private in that manner. And I'll just say one more thing about Dodd-Frank. The qualified versus the non-qualified mortgage, it worked. So the whole point of that in Dodd-Frank was Fannie and Freddie aren't going to take on more risk for the government, our taxpayer dollars, and securitize loans that are non-qualified. And so when the world went to shit in March of 20, non-QM market dried up. You could not trade that security. But Fannie and Freddie were protected because non-QM was carved out, and it wasn't the taxpayer's problem, whether it's a private or public Fannie, Freddie, whatever. It was the private market's problem with private money. And non-QM had to sit on the sidelines and go, shit, do we have enough money to hold these things until maybe the trade comes back around and we can be back in the money. So you follow the money. We buy and sell money.
Yeah, it's interesting because you think about Dodd-Frank, and one of the things that happened in 2018, 2019 was we were talking about the QM patch going away. QM patch was a rule within Dodd-Frank that said if you have a DTI over 43, that it doesn't qualify. It's not a qualified mortgage. So there was an exemption that was in place for Fannie and Freddie to continue to originate loans that were above 43 DTI, and that was going to go away. I think in 2021 was the official date when it was going to go away. So there was a lot of discussion about the private capital markets, about non-QM. Was non-QM big enough to support more loans coming their way if the patch didn't get extended? And thank God. It didn't happen. Thank God they extended the patch. They resolved that situation, because March of 2020, KP's exactly right. The non-QM business went away completely. And it went away because it was entirely reliant on the securitization market as an outlet strategy for the loan. And that was a defect that we didn't really realize in the non-QM space until it happened. And then once it happened, everybody said, okay, these loans are performing. Even after COVID, they were performing. They got back to the regular delinquencies. And after that happened, the market got bigger for us. That's when we saw real money start to come in, because they saw self-employed borrowers get back to business. They saw DSCR loans continue to perform at a high level. And they said, well, if it can survive COVID, then we should invest. And so the market for private capital has gotten better because we're not reliant now on the securitization market. There's still a lot of people that are originating non-QM loans that are aggregating those loans for securitization. And that's fine. It's a good model. It's still working today. Credit spreads are solid. But there's this other piece where it's balance sheet lending. And I think that puts us in a better situation to take on more loans and expand our presence in the market if Fannie and Freddie decide to shrink their footprint.
Cool. Awesome. Well, that's about the time we have. Any questions for anyone? No questions? Actually, we can take the questions outside in the hallway because we are out of time. So, okay. One question.
Yeah, I think in my world we agree with you. There are and as a result of that, there are two categories of loans for these immigrants. We have I-10 loans, and we have foreign national programs, and so we do separate them, and they're very different programs. So the real question here is, and again, it's kind of the push and pull of politics. I mean, there's risk here, and the question is, are these loans going to continue to perform? So our view currently is that if you're an immigrant in the United States and you're here and you're working and you're paying your taxes, you're not going anywhere. And so as a result of that, we have not changed any of our policies on the non-QM side. We've seen a couple companies that I think have put some restrictions in place given what happened with the change in the FHA program, but we haven't seen any real change on our end.
Yeah, that's where we draw the line at the H-1B visa. So HUD pulled it out. We want HUD to put it back in, so it's 3.5% down. Fannie and Freddie still offer it, and then of course we all offer it on our non-QM products, which is more down payment, which is still the biggest hurdle to homeownership.
I think it's messed up, man.
You should have said the F word.
I think it's fucked up, man. All right, I guess we're done. I'll talk to you outside the hallway. Thanks, Brendan. Appreciate it.
Thank y'all.
Thanks, guys.